Did you know the world needs like a crazy amount of money invested in infrastructure every year this decade?
How much you're talking?
$3.5 trillion
Yeah.
every year.
Wow.
Yeah. And that's according to BlackRock's 2025 Global Outlook. AI, the shift to green energy, all of it, it's
Yeah.
all putting a lot of pressure on what we already have, and governments, they just can't handle it alone.
So who's going to fill that gap?
Well, private equity is stepping up in a big way, basically financing the future. And you want to know how they do it, right?
Yeah, especially with inflation going crazy.
Exactly. Specifically, we're diving into how private equity firms, the ones doing those huge leveraged buyouts and institutional acquisitions, how are they finding businesses that are basically undervalued?
Right.
And we'll also look at how they structure deals, make sure the business grows after they buy it and eventually get their money back out. So think funding due diligence and exit strategies, all with inflation kind of looming over everything.
It's a challenge for sure. I mean, think about it. These firms, their whole thing is finding those hidden gems, the businesses that the market is undervaluing. But then inflation comes along and messes with all the traditional valuation models.
That's a good point. It's like, how do you know if a business is struggling because it's, fundamentally flawed, or just because the economy is kind of a mess right now?
Right. That's where understanding how inflation works is so important. The World Economic Forum, they're saying deglobalization is a major culprit.
So countries trying to do more on their own instead of relying on each other for everything.
Exactly. Trade wars, protectionism, tensions with China, it's all pushing prices up.
Yeah, it makes sense in a way. More independence, but the ripple effect on prices, it's crazy. So how are these firms changing how they look for these undervalued businesses?
Well, one way is they're using this concept called replacement cost valuation.
Okay, what's that?
Imagine you wanted to build a similar business from scratch today, like with the inflated prices of materials, labor, everything. How much would it cost?
Oh, so much more now.
Right. That replacement cost is exploding, making existing businesses, even the ones with problems, potentially more attractive.
Like buying a fixer-upper house instead of building a new one?
Exactly. It might need some work, but it's cheaper than starting from zero.
Okay, that makes sense. So they find this business, but then how do they actually buy it with interest rates going up? Borrowing money for these huge leveraged buyouts, it's got to be getting expensive.
You're telling me. The BlackRock report, it mentions some pretty creative financing techniques these firms are using. Things like seller financing, where the seller actually loans part of the money to the buyer.
Wow, so the seller's betting on the buyer to make the business successful. That's a lot of trust.
It is. And there are other approaches too, like earnouts, where part of the final price depends on the company hitting certain performance goals after the acquisition.
So it's more collaborative instead of just a clean break.
Right. It's a way to share the risk and incentivize the previous owners to help with the transition.
I like that. What about the due diligence process? Does inflation change how they assess a potential acquisition?
Oh, absolutely. Due diligence when there's inflation means you have to be laser focused on a company's resilience to rising costs. Can this business raise prices without losing all its customers? How efficient is their supply chain?
So you really need to understand how the business will handle rising prices. It's not just looking at the numbers on a spreadsheet.
Exactly. You have to dig into the operations, and that's where things like AI come in. Reports like the one from Deloitte Insights on AI and financial services, they're suggesting AI could be used to analyze all this data and pinpoint those companies that are best positioned to handle inflation.
Okay, I see where you're going with this. So the private equity firm has done its homework. They've figured out the financing and acquired this promising business. Now what? How do they actually make it grow with inflation still a problem?
Operational expertise, that's their secret sauce. They're not passive investors. They get involved in the day-to-day operations. They bring in their own experts to find inefficiencies and make things run smoothly.
It's like a business makeover, but with a lot more money involved. What are some specific things they focus on?
Well, there's optimizing the supply chain, getting better deals with suppliers, and even taking a look at the company's products or services. Do they still make sense? They might also need to rethink pricing strategies.
Yeah, that's tricky. Finding the right balance between covering costs and staying competitive.
It's a balancing act for sure. You need to know the market and the customers really well. And you can't forget about talent. Attracting the right people is key for any business, but especially now with so much change happening.
Right. And with everyone wanting remote work options and flexibility, how are these firms adapting to that?
They're embracing it. The World Economic Forum and even Psychology Today have talked about this offering remote work can be a huge plus for attracting and keeping top talent.
I mean, if a company values your time and gives you more control over your schedule, that's a big deal.
It is. And it can help control costs, too, which is always good when there's inflation. So we've covered how they find these businesses, how they buy them, and how they improve them. But eventually they have to sell, right?
Right. How does inflation affect their exit strategy? They need to cash out eventually, but isn't inflation eating away at their returns?
It's a challenge for sure. Inflation, it can change how long they hold on to a business. If inflation's eating away at their returns, they might want to sell sooner. It also affects how much investors are willing to pay.
So it's a race against time almost. They need to get out before inflation eats up too much of their profit, but also make sure the business is doing well enough to attract a good price.
Exactly. And it might mean looking beyond traditional IPOs. Selling to other private equity firms or corporations starts to look more appealing in this kind of market, especially with everyone competing for resources like the BlackRock report mentions.
It's so fascinating to see how all of this works. Private equity firms really have to be strategic to thrive when there's inflation.
They do. It's not just reacting to it, but figuring out how it's going to evolve and adjusting their plans accordingly.
Which makes me think about all this stuff about AI we've been reading about. The Deloitte report about generative AI and how it's going to change financial services.
Oh, yeah. It's already being used to analyze tons of data and find investment opportunities.
So do you think AI could completely change how these firms identify and value businesses, especially with inflation?
That's the big question, isn't it? Could AI help them spot those hidden gems, the ones that can actually do well, even with inflation, the businesses that might get overlooked using traditional methods?
And on the other hand, could AI also help them spot the risks? Identify the businesses that look good on paper but are actually in trouble when prices start going up.
Exactly. What if AI could analyze potential deals, test out different financing scenarios, and even figure out the best exit strategy?
That would be a game changer.
It would. It's like a whole new level of sophistication.
AI really could be a game changer for private equity, especially with inflation changing how business works.
No doubt about it. It could. And it's not just private equity. Everyone's got to adapt with this inflation. It's everywhere, from houses to what we buy at the store every day.
Speaking of housing, you know that Freddie Mac economic outlook report?
Yeah.
And that says housing prices, they've been a huge driver of inflation, especially in certain places.
And housing, it's not just what we pay personally, it affects businesses too. Higher rents and property prices eat into their profits. They're forced to raise prices, and it just ripples through the whole economy.
It's like a chain reaction.
Yeah.
One price goes up, then another and another.
Exactly.
And the World Economic Forum, they say these regional differences in inflation, they're partly because of how people spend their money.
That's a good point. Like,
Yeah.
take the Northeast. They don't spend as much on transportation as other areas, so when gas prices shoot up, it doesn't hit them as hard, but they might feel it more with rising housing costs.
Yeah, you got to think about those regional differences when you're looking at inflation. It's not the same everywhere.
Exactly. It's a puzzle with all these different pieces affecting each other.
And then you've got the Federal Reserve trying to manage all of this by raising interest rates. It's like walking a tightrope.
It is. They're trying to slow down inflation without causing a recession. They're watching the job market really closely.
So people having jobs and wages going up that can make inflation worse, but we don't want people to lose their jobs either.
Right. It's a tough situation.
You know, that Psychology Today article about remote work and inflation, they made this kind of surprising argument.
Oh, yeah?
They said remote work might actually help bring down inflation.
At first I thought, wait, wouldn't remote work make things more productive and profitable? Wouldn't that add to inflation?
You
But
know,
their point was,
that it could slow down how fast wages are going up. Because with remote work, there's more competition for jobs, so people might be willing to take a lower salary if it means they can work from home.
makes sense. Less spending, lower prices.
Yeah, it shows how these things can connect in weird ways.
For sure. And it's not just about the economics either. There's the psychology of it all.
Right, like that other Psychology Today article we have, it talked about how inflation can mess with people's happiness.
Right. Higher prices, they can make you frustrated. You feel like you can't buy as much, like you're stuck.
Like your happiness is losing value along with the dollar.
Yeah, exactly. And those feelings, they can have real consequences. People might not spend as much or put off big decisions or even play it too safe.
It makes everyone uncertain and anxious. So let's bring it back to private equity for a minute. We talked about how they deal with inflation, but what are the risks? How does inflation mess with their investments?
Well, one big risk is their investments don't do well. Like if the companies they buy can't raise prices or control costs, If profits take a hit, that directly affects how much money they can make for their investors.
And then that could make it harder to attract new investors, right? If a firm's not doing well with inflation, nobody's going to want to give them money.
Exactly. It's a vicious cycle. Another risk is rising interest rates. The Fed's trying to control inflation, so those leveraged buyouts we talked about, they become more expensive to finance.
So their costs go up, their profits go down. It doesn't sound like a good environment to be in. But there have to be some opportunities too, right? Inflation can't be all bad for private equity.
You're right, there are always two sides to every coin. Remember, replacement cost valuation. When inflation makes it expensive to build new businesses, the existing ones, they start to look pretty good.
Like finding a classic car in perfect condition.
Mhm.
Suddenly it seems like a steal compared to a brand new one.
Exactly. Private equity firms can buy these businesses for a lower price and potentially make more money down the road.
So it's about finding those diamonds in the roughs, the businesses that can handle the tough times and come out stronger.
Exactly. That's where their operational skills really come in. They help these companies be more efficient, control their costs, and grow. They don't just survive, they thrive even with inflation all around them.
You know those excerpts from the Federal Reserve's FED's notes?
Uh-huh.
They talked about all these interesting trends, like how money's flowing to the U.S. and the role of the U.S. dollar.
Those trends, they matter a lot for private equity. A strong dollar makes it more expensive for U.S. firms to invest overseas, and a weak dollar.
Makes U.S. stuff look cheap to foreign investors.
Exactly. That could boost valuations for their portfolio companies.
So it's all connected. It's like a web. Everything's pulling on something else. What about those BIS reports? Anything stand out to you?
The BIS quarterly review report, they really hit on how financial stress makes inflation even worse. When markets are jumpy and investors are nervous, it's harder for businesses to get the money they need to grow.
It's like a downward spiral. Inflation causes financial stress, which makes it harder to handle the inflation in the first place.
Right, exactly. That's why it's so important for policymakers to keep things stable and communicate clearly. Uncertainty just adds to the anxiety.
Speaking of uncertainty, that research paper on the economic impacts and regulation of AI, it talked about how AI could make inequality even worse.
Yeah, if AI just benefits the people who already have money and resources, it's going to widen the gap between the rich and the poor.
And that could be a big problem for private equity. If AI is used to concentrate wealth even more, it could erode trust in the system and lead to social unrest. Nobody wins in that situation.
We've got to make sure AI is used responsibly and ethically. It should be used to create a fairer society, not make things worse.
Yeah, it's a challenge that needs everyone to work together, policymakers, tech experts, business leaders. We can't just let it happen on its own.
Absolutely.
AI is a powerful tool. We need to be careful with it. What other risks with AI did we find in our research?
Well, that BIS report on the procyclicality of margin requirements, it got me thinking. It talked about how financial risk models, sometimes they can make market swings even worse.
So when things are already volatile, these models actually make them more volatile instead of calming things down.
Right. And the same thing could happen with AI-driven investment strategies. If the models make market cycles worse, it could lead to a lot of instability.
Imagine a bunch of private equity firms all using similar AI models to find undervalued businesses.
And they all point to the same sector or asset class.
So everyone rushes to invest in that area, prices go up, and you've got a bubble.
And then when the models say sell,
Crash. And it affects the whole economy.
it's not a pretty picture. We can't just rely on models blindly, even if they seem really smart. We need diversity in our thinking and our approaches.
And regulation and oversight to make sure these technologies are being used responsibly and are not putting the whole financial system at risk. That Urban Institute study on the true cost of economic security, it was eye-opening.
Yeah.
Even when the economy's doing okay, a lot of people are still struggling to get by.
It's true. And that economic insecurity, it has a ripple effect. It affects people's health, their education, their ability to save for the future.
And it holds back the whole economy. When people are struggling, they don't spend as much, and that can slow down economic growth. It's a tough cycle to break.
It is. We need policies that help people get ahead and feel secure. Things like affordable housing access to healthcare and quality education.
Yet we need a system where everyone has a fair chance to succeed and reach their full potential.
I couldn't agree more. And private equity firms, they can be part of the solution too. If they invest in businesses that create good jobs and contribute to a strong economy, they can help make things better for everyone.
A rising tide lifts all boats, right?
Well said. You know that Deloitte report on the impact of inflation on business? They had some good advice.
What do they suggest?
They said businesses need to optimize their supply chain, negotiate better deals with their suppliers, and be smart about pricing.
They also talked about investing in technology and innovation to become more efficient.
Right, and don't forget the human element. Businesses need to understand how inflation is affecting their customers emotionally and adjust their strategies accordingly.
It's about building trust and keeping those relationships strong, even when things are tough. You know that Motley Fool article about investments to hedge against inflation in 2025?
Yeah, they had some interesting ideas.
They covered a lot of ground stocks, real estate, even TPS.
It's a good reminder that there are ways to protect your money from inflation.
But it's important to remember every investment has risks, and there's no guarantee you'll beat inflation.
It's always a balancing act, weighing the risks and the potential rewards and making choices that fit your goals and your risk tolerance.
And it's never a bad idea to talk to a financial advisor before you make any big decisions.
For sure.
Those salary negotiation tips from Forbes were helpful too, especially now with inflation. You need to know your worth and negotiate a salary that keeps up with rising prices.
Absolutely. You have to advocate for yourself and make sure you're being paid fairly for what you bring to the table.
And you've got to know the market. What are other companies paying for similar jobs? That gives you leverage.
It's like a game of chess. You have to think strategically and anticipate what the other side's going to do.
I thought the Goldman Sachs inflation report was insightful too. They gave some good context on what's driving inflation or what it could mean for the economy.
And they touched on the big question, will the Fed stick the landing? Can they control inflation without causing a recession?
That's the million-dollar question, isn't it?
It is. It's a complicated situation, and there's no easy answer. We're in uncharted territory.
But if we understand what's happening, we can make better decisions and navigate these choppy waters. That study from behavioral scientists about cash transfers in Kenya was fascinating.
Oh, yeah. They gave cash directly to low-income families and tracked what happened.
And the results were amazing. It wasn't just good for the people who got the money.
Yeah.
It helped the whole community.
It's true. The money they got helped boost the local economy.
It's a great example of how targeted help can make a difference. It makes you wonder about different approaches to poverty and inequality.
Yeah, there's no one solution that fits everyone. We should be open to new and creative ideas.
You know that article about how to make inflation invisible? It was kind of sneaky.
Oh, yeah. It was all about skimpflation.
Skimflation.
It's when they lower the quality or the amount of stuff in a product but keep the price the same.
So you're paying the same, but you're getting less.
Exactly. It's like hidden inflation.
And it's everywhere. Smaller packages, less customer service businesses are always finding ways to cut costs without actually raising prices.
It's true. We have to be more aware as consumers. Pay attention to the details.
Yeah, don't just look at the price tag. Think about the value you're getting.
And don't be afraid to say something if you feel like you're being cheated. Hold those businesses accountable. Demand transparency.
I like that. So we've covered a lot of ground today, from how private equity is dealing with inflation to the broader impacts on the economy and society.
And we've seen how businesses are adapting, the role technology is playing, and even the psychological effects of all this.
But there's one last question I want to leave our listeners with, something to really chew on.
I love a good thought-provoking question.
We've talked about how private equity firms are adjusting to inflation. But what if they're not just adapting? What if they're actually making inflation worse?
And that's interesting. How do you mean?
Well, think about it. They're buying companies, streamlining things, and often raising prices to make more profit. Could all of that be contributing to inflation? Especially on a large scale.
That's a great question. It really makes you think about the role of private equity in the economy. Are they making things more efficient and creating value, or are they just taking value and making existing problems worse?
It's a complicated issue with no easy answers. It really makes you think about their impact.
It does. There are definitely arguments to be made on both sides. It's not a simple issue.
And it makes me think about that Goldman Sachs report. They said that long-term expectations for earnings per share have been going down.
Yeah, I noticed that too. It seems like even though the stock market is doing okay, investors are kind of worried about future earnings growth.
Which makes sense with all the uncertainty around inflation, interest rates, the global economy. It's like the market's already bracing itself for a possible slowdown.
The market's always trying to predict the future, isn't it? It's a good reminder that what happened in the past doesn't guarantee what'll happen next.
Speaking of the future, that OECD report on science, technology, and innovation, it really emphasized the potential of AI to change everything.
They talked about how AI is being used in so many fields already, healthcare, finance, manufacturing, and they think it's only going to become more important in how we live and work.
It's exciting, but it also brings up a lot of questions and concerns.
We have to be careful about how we develop and use AI. We need to make sure it's used ethically and that everyone benefits.
Which brings us back to our original question. How is inflation changing business valuations, especially for firms doing private equity and institutional acquisitions?
We've looked at this from so many angles today, from the overall economy to the challenges of figuring out what a business is worth in this crazy market.
We've talked about due diligence creative financing and how important operational expertise is to navigate all of this.
But it's a moving target, isn't it? Inflation is always changing, and how it affects valuations is always changing too. There's no easy answer, no magic formula.
Exactly. That's why it's so important to stay informed, keep up with the latest trends, and be ready to change your strategies as needed.
This deep dive has given everyone a good understanding of how inflation is changing the business world and what to look out for.
We've covered a ton of information, and I hope you feel more confident in dealing with these complicated issues.
It's been great diving deep with you today.
Until next time, stay curious and keep exploring.